What if the people paid to protect your money were actually paid to lose it? In the shadow of the 2008 financial crisis, a silent engine of destruction was revealed. They are the credit rating agencies, the undisputed gatekeepers of capital. But behind the curtains lies a broken incentives model that compromises your financial investment security. We are uncovering the systemic issues that turned the global market into a rigged casino, from the ashes of the housing bubble to the ongoing financial risks threatening your retirement today. This is the story of how the watchdogs became accomplices. We will expose the hidden vulnerabilities in the financial system and why you can't trust the safe label on your investments. Buckle up. It's time to follow the money.
You've just been robbed, and the worst part, you didn't even know it was happening. Imagine this. You're standing in a car dealership, about to make one of the biggest purchases of your life. You're nervous, so you do the smart thing. You hire a mechanic to inspect the vehicle before you hand over your hard-earned cash. He runs his tests, checks under the hood, kicks the tires, and gives you a confident thumbs up. AAA condition, he says with a smile. This baby is rock solid. Relieved, you sign the papers, drive off the lot, and within minutes, the brakes fail. You crash. The airbag doesn't deploy. You're left sitting in a wreck, stunned and furious. Later, you discover the truth. That mechanic wasn't working for you at all. He was paid a fat bonus by the dealership to lie to your face and tell you the car was safe. You just got scammed, and the system was designed that way from the start. Now here's the question that should terrify you. What if I told you this exact scam is happening right now, at a global scale, with your retirement savings, your home value, and your financial future? What if the mechanics inspecting the safety of trillions of dollars in investments aren't working for you either, but for the very people selling you the risk? You'd probably think that's illegal. You'd assume someone would stop it, but you'd be wrong. Because this isn't some back alley hustle. This is the foundation of the modern financial system, and it's perfectly legal. There are 3 names you need to know: Moody's, Standard & Poor's, and Fitch. These are the credit rating agencies, the so-called independent experts who decide what's safe to invest in and what's not. They slap ratings on everything from corporate bonds to mortgage-backed securities, and the world listens. Governments, pension funds, banks, they all trust these ratings like gospel. But here's the invisible truth no one talks about. These agencies don't work for you. They work for the companies they're supposed to be rating. It's called the issuer pay model, and it's one of the most dangerous conflicts of interest ever normalized in global finance. The same entities that need a good rating to sell their products are the ones paying for that rating. Let that sink in. You already passed by this, didn't you? Maybe during the 2008 crash when your 401k evaporated, or when your neighbor lost their home. And here's the terrifying part. This system didn't end in 2008. It's still quietly draining your money today. Stay with me until the end, because what you're about to discover isn't just history. It's happening right now, and it's costing you more than you think. By the end of this video, you'll understand exactly how the issuer pay trap works, why it turned the housing market into a rigged casino, and most importantly, how you're still paying the price. So buckle up, because the real story behind the 2008 financial crisis isn't what they taught you in school. Before we go deeper, I need to say something important. These companies, the Big Three, control roughly 95% of the global credit rating market. They are the gatekeepers of capital. And exposing their business model isn't just controversial, it's dangerous, because it challenges the very foundation Wall Street is built on. That's exactly why I need your help right now. Liking this video is one of the few ways to push this information past the gatekeepers and into the hands of people who need to see it. Your engagement tells the algorithm this matters, so hit that like button, and if you want more truth like this, subscribe, because we're just getting started. And here's what I really want to know. Have you ever been burned by an investment that was supposed to be safe or highly rated? Maybe in 2008, or even recently? Drop your story in the comments below. Your voice matters here, and sharing it helps build a community that refuses to stay silent. Now let me take you back to the exact moment this entire system went off the rails. Because to understand the scam, you have to understand what I call moment zero. The point where the rules quietly changed, and nobody stopped to ask if maybe, just maybe, this was a terrible idea. In the early 20th century, if you wanted to know whether a bond or investment was safe, you did what any smart person would do. You paid a subscription to a credit rating agency. This was called the investor pay model, and it made perfect sense. The agency worked for you, the investor. If they gave you bad advice, if they told you something was safe and it wasn't, you'd cancel your subscription and move on. Their entire business model depended on one thing: telling you the truth. Because if they didn't, they'd lose customers and go out of business. Simple, honest, aligned incentives. But then, in the 1970s, something completely unexpected broke this system wide open. The photocopier. Yeah, you heard that right. A piece of office technology that most people don't even think about anymore became the catalyst for one of the biggest financial conflicts of interest in history. Here's what happened. As photocopiers became common, information started spreading faster than anyone anticipated. Investors would buy one subscription to a rating report, photocopy it, and share it with colleagues, friends, other firms, basically anyone who wanted it. The agencies were producing valuable research, but fewer and fewer people were actually paying for it. This created what economists call a free rider problem. Everyone wanted the information, but nobody wanted to pay. Revenue started drying up. The business model was collapsing. So the agencies did what any struggling business might do. They innovated. Except this innovation wasn't about better research or more accurate ratings. It was about flipping the entire business model upside down. They adopted what's now known as the issuer pay model. Instead of charging you, the investor, to read their reports, they started charging the banks, corporations, and financial institutions, the very entities whose debt they were supposed to be rating. Let that sink in for a second. Suddenly, the company trying to borrow money, the one trying to sell bonds or securities to the public, was paying the referee to judge whether they were creditworthy. The agency's customer was no longer the investor trying to make a smart decision. The customer was now the bank, the corporation, the Wall Street firm. And we all know the golden rule of business. The customer is always right. What sounds like a small business decision, a pragmatic response to a revenue problem, would soon become the single most destructive conflict of interest in modern finance. Because when the people being graded are the ones paying your bills, guess what happens? The grades get inflated, the risks get hidden, and the truth becomes optional. Now I want to go even deeper into this because this is where it gets truly insane. Once this system was in place, the incentives became crystal clear. If Moody's gave a tough, honest rating to a bank's mortgage-backed security, that bank could just walk across the street to Standard & Poor's and pay them for a better grade. It became a race to the bottom. The agency that was willing to slap the highest rating on the riskiest garbage won the business. And in the lead up to 2008, that's exactly what happened. Toxic mortgages, loans given to people who couldn't afford them, packaged together and sold as safe investments, were getting stamped with AAA ratings, the same rating given to US Treasury bonds. The agencies knew what they were doing. Internal emails later revealed analysts joking about how bad the deals were, but they rated them anyway. Because if they didn't, someone else would. The transformation from watchdog to accomplice was complete. The very institutions designed to protect you had become part of the con. And here's the kicker. After the entire global economy collapsed, after millions lost their homes, their jobs, their savings, none of these agencies were held criminally accountable. They claimed they were just offering opinions, protected by the First Amendment. Opinions, as if labeling a financial weapon of mass destruction as safe is the same as a movie review. This wasn't ignorance. This was a system working exactly as designed. A system where the truth was sacrificed at the altar of profit, and you were left holding the bag. If this is making you angry, if this is starting to click, Drop a comment right now and just write, "I see it now." Let me know you're with me on this, because we're not done yet. Now I want to show you the exact mechanics of how this trap actually works in practice, because once you see it, you can't unsee it. This shift to the issuer pay model created something called rating shopping, and it's one of the most elegant scams ever designed. Here's how it plays out. Imagine a large investment bank wants to sell a bundle of risky mortgages to investors. They package thousands of loans together and need a rating to make it sellable. So they approach Moody's and ask, "How would you rate this product?" If Moody's looks at the data and says, "This looks pretty risky, we're thinking maybe a B rating," the bank doesn't argue. They don't try to fix the product. They just smile, walk across the street to Standard & Poor's and say, "Moody's wasn't very cooperative. If you give us a AAA rating, we'll pay you $1 million for this deal." And just like that, S&P has a choice: tell the truth and lose the business, or inflate the rating and cash the check. The agencies became terrified of losing market share. In emails uncovered during congressional investigations after the crash, analysts at Standard & Poor's were literally discussing how they needed to loosen their standards just to keep clients from going to Moody's. One employee famously wrote about a structured finance deal. "It could be structured by cows, and we would rate it." Let me repeat that. Structured by cows. That's not hyperbole. That's an actual internal email from a ratings analyst admitting they would slap their stamp of approval on anything, no matter how absurd, as long as the fee was paid. This wasn't ignorance or incompetence. This was a business decision, a calculated trade-off between integrity and profit won every single time. But here's where it gets even more twisted. To cover up the fraud, the banks and agencies use something called financial engineering. It sounds sophisticated, almost scientific, but it's really just a fancy term for hiding the truth under layers of complexity. They took thousands of subprime mortgages, loans given to people with no jobs, no income, no assets, people who were never going to be able to pay them back, and bundled them together into massive pools. These pools were called CDOs, or collateralized debt obligations. The pitch was simple and seductive. By mixing thousands of bad loans together, the risk somehow magically diversified away. If one person defaults, no big deal, because you've got thousands of other loans backing it up, right? Wrong. It was a lie dressed up in math. What they were really doing was taking a pile of garbage, wrapping it in a shiny package, and convincing everyone it smelled like roses. Some journalists and investigators later called this process ratings laundering, and that's exactly what it was: laundering. Taking something toxic and making it look clean. The transformation was purely cosmetic, but the impact was catastrophic. Because once these toxic products got stamped with a AAA rating, the same rating given to the safest investments in the world like US Treasury bonds, they were sold to pension funds, retirement accounts, insurance companies, foreign governments, institutions that were legally required to only buy safe investments. The ratings gave them permission to buy poison. And when the housing market collapsed, when people started defaulting on those subprime loans in massive numbers, the entire facade crumbled. Those AAA-rated CDOs turned out to be worth pennies on the dollar, if anything at all. Trillions of dollars in wealth evaporated. The global economy froze. And the agencies? They shrugged and said, "Hey, we were just giving our opinion." But opinions have consequences. Decisions based on corrupted information destroy lives. This wasn't a mistake. This was a system designed to prioritize short-term profit over long-term truth. And the revelations that came out in the aftermath proved it beyond any doubt. The hidden truth is this: the entire structure of modern finance rests on the assumption that someone, somewhere, is telling the truth about risk. And when that assumption is false, when the referees are bought and paid for, the whole game becomes a lie. If this is starting to feel like a massive betrayal of trust, write this in the comments. The system is rigged. Now let me show you what this actually cost. Because this isn't some abstract financial theory or Wall Street drama that only affects billionaires. This is about your money, your family's future, and the quiet theft that happened while everyone was being told everything was fine. In the years leading up to 2008, the big three rating agencies stamped trillions of dollars worth of mortgage-backed securities with AAA ratings. That's the highest possible grade, the same rating given to U.S. Treasury bonds, investments considered so safe they're basically guaranteed by the full faith and credit of the United States government. Except these weren't Treasury bonds. These were bundles of subprime mortgages, loans that were destined to fail. And when the housing bubble finally popped, those AAA-rated assets became worthless overnight. The financial upheaval that followed wreaked havoc in communities and neighborhoods across the entire country. The 2008 crisis didn't just hurt Wall Street. It wiped out $11 trillion in household wealth. 11 trillion. That's not a number you can easily wrap your head around, so let me make it personal. That's people losing their homes, their savings, their ability to send their kids to college. That's entire neighborhoods turning into ghost towns filled with foreclosure signs. That's millions of families watching their nest eggs evaporate because someone, somewhere, lied about how safe an investment was. But it gets even worse when you zoom in on who got hurt the most. Pension funds, the money set aside for teachers, firefighters, police officers, nurses, all the people who spent their lives serving their communities, are often legally required to only invest in what's called investment-grade securities. That means they can only buy things rated BBB or higher. It's supposed to be a safeguard, a rule designed to protect people's retirements from risky bets. But because the rating agencies lied, because they slapped AAA ratings on financial garbage, these pension funds bought toxic waste thinking it was gold. They had no choice. The law required them to trust the ratings, and the ratings were fraudulent. The California Public Employees Retirement System, known as CalPERS, is one of the largest pension funds in the country. After the crash, they sued the rating agencies for over $1 billion in losses, arguing that they were deceived by inflated ratings. $1 billion that was supposed to fund the retirements of people who spent decades in public service. And CalPERS wasn't alone. Pension funds across the country, managing the futures of millions of working people, suffered devastating losses because they trusted a system that was designed to lie to them. This isn't just Wall Street losing money and getting bailed out by taxpayers. This is your future, your parents' retirement, your neighbor's ability to live with dignity after a lifetime of work. All of it gambled away by a handful of companies that faced zero accountability. For millions of Americans, this wasn't a market correction or an economic cycle. It was the moment their future quietly disappeared, and most of them never even understood why. The impact wasn't just financial. It was a betrayal of trust on a scale that's hard to fully comprehend. People spent their entire lives playing by the rules, saving responsibly, trusting the institutions that were supposed to protect them. And those institutions sold them out for a fee. The revelation of how deep this fraud went didn't come out immediately. It took years of investigations, lawsuits, congressional hearings, and journalists digging through emails and documents to piece together the full picture. And what they found was a system where every incentive pointed in the wrong direction, where doing the right thing meant losing business, and where the truth was treated as optional. The mental shift required to understand this is profound. Most people go through life assuming that when something is labeled safe by an official authority, it actually is safe. We trust food labels. We trust building inspectors. We trust financial ratings. But what happens when that trust is weaponized against you? What happens when the label is a lie and the inspector is on the payroll of the company being inspected? That's the hidden reality of the financial system, and it's still in place today. If this is landing for you, if you're starting to see just how deep this goes, drop a comment and write, "This is personal now." Now I want to show you who actually profits from this entire rigged system, because when you follow the money to the top of the pyramid, the picture becomes crystal clear. This isn't just about rating agencies making a few bad calls. This is about a power structure that rewards deception and punishes honesty. Let's start with the agencies themselves. Moody's, for example, wasn't just surviving under the issuer pay model, it was thriving. During the years leading up to the crash, Moody's had operating profit margins consistently above 50%. 50%. That's higher than tech giants like Microsoft and oil behemoths like ExxonMobil. Think about that for a second. A company whose job is supposed to be providing objective analysis was making more profit per dollar of revenue than some of the most profitable corporations on the planet. Why? Because they weren't selling analysis. They were selling access, approval, and the appearance of legitimacy. But the agencies weren't the only ones cashing in. The real beneficiaries were the investment banks and hedge funds who learned how to game the system like a rigged casino. And one of the most infamous examples of this is a deal called Abacus 2007 AC1, orchestrated by Goldman Sachs. Here's how it worked. Goldman allowed a hedge fund manager named John Paulson, not the former Treasury Secretary, different guy, to help select the mortgage bonds that would go into this investment product. But here's the twist. Paulson wasn't buying into the deal. He was betting against it. He specifically handpicked mortgage bonds that he believed were going to fail, bonds that were backed by subprime loans destined to default. Goldman packaged these doomed assets into a product and sold it to investors, including a major German bank. And the rating agencies? Moody's and Standard & Poor's both stamped Abacus with a AAA rating, giving it their seal of approval as a safe, high-quality investment. The investors trusted the ratings and bought in. When the housing market collapsed, those investors lost nearly everything. The German bank alone lost hundreds of millions of dollars. Meanwhile, John Paulson, the guy who helped pick the toxic assets specifically because he knew they would fail, walked away with over $1 billion in profit. $1 billion. And the rating agencies were the essential cogs that made this entire machine of destruction work. Without those AAA ratings, the deal never would have sold. The ratings provided the cover, the legitimacy, the permission for investors to buy poison. But here's where it gets absolutely infuriating. When these agencies get dragged into court and sued for fraud, for negligence, for the trillions of dollars in losses their bogus ratings caused, they hide behind one of the most cynical legal defenses you've ever heard. They argue that their ratings are just opinions, protected by the First Amendment. Yeah, you heard that right. They claim they have freedom of speech to be wrong, even when they're paid millions of dollars to be experts. They compare their ratings to movie reviews, saying that just like a film critic can give a bad movie 5 stars without being sued, they can give a toxic financial product a AAA rating and face no consequences. It's the ultimate shield. They take money from the banks to rate their products. They inflate those ratings to win business. The global economy collapses because people trusted those ratings, and then they turn around and say, "Hey, we were just sharing our opinion." First Amendment, baby. The audacity is almost breathtaking. This legal defense has largely worked too. Despite the devastation, despite the evidence of conflicts of interest and internal emails showing they knew what they were doing, the agencies have faced almost no meaningful accountability. No criminal charges, no executives in handcuffs, just some fines that amounted to a rounding error compared to the profits they made. The transformation from trusted institutions to enablers of fraud is complete, and the system protects them at every turn. The revelations from court cases, congressional hearings, and investigative journalism have laid all of this bare. The receipts are there. The emails exist. The money trail is clear. And yet the machinery keeps running, because the people at the top of the pyramid benefit too much from keeping it in place. If you're realizing just how calculated and deliberate this entire setup is, write this in the comments. Follow the money. Now I want to give you something practical, because understanding the problem is only half the battle. The real question is, what do you do with this knowledge? How do you protect yourself when the system is designed to work against you? The truth is, you can't change Wall Street overnight, but you can change your own decisions, your own mindset, and the way you navigate this rigged game. And that transformation starts with rejecting the lies you've been conditioned to believe. First, you need to stop trusting the letter grade. I know that sounds simple, but it's harder than it seems, because we've been trained our whole lives to trust credentials, certifications, and official stamps of approval. A AAA rating does not mean an investment is safe. What it often means is that the issuer paid a high enough fee to get that rating. Treat credit ratings as a starting point for your own research, not as a conclusion. If someone is selling you something and pointing to a rating as proof of quality, that should be a red flag, not a green light. Ask yourself, who paid for this rating? What incentive does the rating agency have to tell the truth? The moment you start questioning the source of the information, you take back power. Second, look for what's called skin in the game. This is a concept that cuts through a lot of the noise in finance. During the 2008 crash, one of the most telling signs of fraud was that the people selling mortgage-backed securities were betting against the very products they were selling to you. They knew it was trash. They were profiting whether you won or lost, and in many cases, they made more money when you lost. So here's the rule. Avoid complex financial products where the seller makes money regardless of your outcome. If someone is getting paid just for moving the product, not for the product actually performing well, you're not a customer, you're a mark. Real advisors, real experts, real partners have their own money on the line. They win when you win. That alignment of interest is everything. Third, and this is where it gets bigger than just your personal portfolio, you need to demand reform. After 2008, Congress passed the Dodd-Frank Act, which tried to address some of these problems. It created the Office of Credit Ratings to oversee the agencies and reduce conflicts of interest. But here's the uncomfortable truth. The issuer pay model still exists. The fundamental conflict of interest is still baked into the system. And it's not just happening in the mortgage market anymore. Right now, the private credit market is booming. We're talking about a $1.7 trillion market, and regulators are already warning that rating shopping is happening all over again. The same playbook, the same incentives, the same lies, just with different products and different labels. The agencies haven't changed, the banks haven't changed. The only thing that's changed is the packaging. We need to push for models where investors pay for ratings, where the people relying on the information are the ones funding the analysis. That's how you restore the alignment of trust. That's how you go back to the system that actually worked before the photocopier broke it. But that kind of change doesn't happen unless people understand what's broken and demand something better. This isn't about becoming cynical or paranoid. It's about becoming informed and intentional. The hidden machinery of finance operates in the shadows because most people don't know it exists. But once you see it, once you understand how decisions at the top trickle down and impact your savings, your job, your community, you can't unsee it. And that awareness is the foundation of resistance. You stop being passive, you start asking questions, you demand transparency, you vote with your dollars and your voice for a system that actually serves the people it's supposed to protect. The journey from ignorance to understanding is uncomfortable, but it's also empowering. Because the moment you realize the game is rigged, you also realize you don't have to keep playing by their rules. If this resonates with you, if you're ready to stop being a passive participant in a broken system, drop a comment and write, "I'm awake now." If you made it all the way to the end of this video, you're not like most people. Most people hear this kind of information and tune out because it's uncomfortable, because it challenges everything they've been told to trust. But you stayed, you listened, you questioned, and that matters more than you think. The credit rating agencies sold the world a lie that nearly destroyed the global economy, and they did it because the system rewarded them for looking the other way. They turned financial markets into a rigged game where truth became optional and profit became the only rule that mattered. But now you see it. You understand how the mechanics work, how the incentives are broken, and why the same patterns keep repeating. That awareness is the first step toward making different decisions, demanding better systems, and refusing to be a passive victim of a game designed to extract wealth from people like you. If this video opened your eyes, if it changed the way you see the financial world, do me a favor. Leave a comment right now and just write, "I see the system." I want to know you're out there, that this message landed, that we're building a community of people who refuse to stay blind. And if this kind of content is valuable to you, hit that like button and subscribe to the channel, because I'm not stopping here. There's so much more to uncover, and I need you with me on this journey. Before you go, there's another video you need to watch. It digs into how the banks themselves manipulated the housing market before the rating agencies even got involved. The rabbit hole goes deeper than you think, and if you're ready to keep going, click the video on your screen right now. I'll see you there.